Hi, Andrew here again. ESG investing has grown in prominence and popularity over the past few years. So the purpose of this video is to explain a bit more about what ESG investing is and why it can make up an important part of an investment portfolio. In simple terms, it's about making sure your money is being used positively and in line with your values. Because the traditional approach to investing is that you couldn't invest with a purpose for a positive reason to make a positive change and have a profit as well. It was an either or situation. But nowadays and increasingly it's possible to make sure that you have your money invested in line with your values and what's important to you and enjoy a financial return as well. So as I said, ESG investing is about investing with purpose. We make buying behaviors every day, and increasingly they're aligned to how we feel about our role in the world, making sure we're not having a negative impact. So we're reducing the amount of plastic consumption or reducing our carbon footprint by buying electric vehicles. And ESG investing takes a similar approach to see how we are investing our money in the types of companies that our money is invested with, so we are not having a negative impact on the world and society. So it splits it into three main areas: the environment, which would look at carbon reduction, reducing climate change, habitat destruction and species extinction, and also limiting the loss of resource scarcity, things like water. From a society point of view, from a social point of view, it's looking at how companies engage with their employees. Is there diversity and inclusion in the workplace? Is there fair pay and fair conditions? But also looking at how companies interact and engage with the stakeholders in the business. So that would be the suppliers and distributors. Are there fair contracts and fair pay? And what are their interactions like with the wider community in which they operate? At the governance level, it's looking at the boards to see that there is fair executive pay, that there's diversity amongst board members, that there's transparency in the financial accounts, that there's no risk of bribery, corruption or inappropriate lobbying of political parties, and also that they're paying a fair degree of corporation tax. So if you think about where ESG fits on a spectrum, standard investing has all been about getting the highest return that you can for the risk you're willing to take, and there's been little control or little decision making by the investor about how the money is ultimately invested. It's all about that return. At the opposite end, philanthropy is less concerned about any financial return. It's all about making a positive impact and a difference for a particular project or a cause. So you might invest with a particular charity or a particular project that aims to have a demonstrable positive, make a positive difference, which is measurable. In between that, in the middle, has always been what's been known as ethical investing or socially responsible SRI investing, and that's where investors would screen out particular sectors or companies, typically the sin stocks of gambling, alcohol, tobacco, adult entertainment, and armaments. Or you'd take a positive skew and only invest in companies within particular sectors, for example, the environment. But the problem with that approach is that you're limiting your investment choices, which brings with it additional risks or the loss of potential return because you've got a smaller universe. Impact investing is looking to get a degree of financial return, but you want to have a direct impact on a particular area. Again, for example, within environmental aspects. So ESG sits between the traditional approach and ethical investing. So, well, we want a financial return, it's important to us, but we want to know that our money is being used for good. And it won't automatically exclude these sin stock sectors. Some ESG approaches will do, but otherwise it's looking at the best of breed, those companies, for example, in oil and gas that are making positive steps to reducing carbon emissions and global warming, and looking to invest more in renewable technologies. And it will also look to exclude the worst offenders along those ESG metrics in a particular sector or industry. And whenever you want to invest money and you're doing so with a particular theory or hypothesis, you want to make sure there's evidence that backs it up, and it's just not marketing spiel. And increasingly with ESG investing, there is a growing body of evidence that it does provide either greater financial returns or reduces risk whilst having that positive change. A number of research reports have been done that shows ESG leads to stronger cash flows and lower borrowing costs and higher valuations for companies, and therefore for company share prices. And research by Harvard shows that US firms with strong track records on sustainability have significantly outperformed those companies with poor metrics in those same areas. And it makes intuitive sense if you think about it. A company that is a polluter or has a high carbon footprint is risking being exposed to carbon tax or carbon penalties by governments that are bound to start imposing them at some point. Or if they have a poor publicity because of a particular interaction engagement with staff or their stakeholders, that doesn't do well for their brand. Conversely, companies that have high employee engagement and operate well with the stakeholders in their company are more likely to be more productive, have better PR, better brand awareness, and therefore higher sales and turnover. And when you look at the numbers, you can see that this stacks up as well. This is research by BlackRock that looks at data from 2012 to 2018, and you can see across a number of different financial metrics, the ESG does stand up compared to traditional approaches. If you look at the annualized return, they're similar, if not better than the standard traditional investing approaches. And from a volatility point of view, volatility being how much risk is being taken, how much the value of company shares change over time, you can see that the results are very similar. So it's possible to get a higher financial return for no additional risk. And also, when stock markets crash, there's also evidence that those companies that fit with an ESG focused approach perform less badly, less poorly. Now, this data is up to 2018, as I said, but it was also evidence that in the height of the pandemic crisis in 2020, ESG focused investments performed less poorly than those of a traditional approach. So in summary, ESG investing now does give a real opportunity to align your investment approach, your investment principles to your values and how you spend your money on a day-to-day basis. And there is increasingly a growing body of evidence to say that you can get a financial return with less risk as well. So that's really what I wanted to cover. If you've got any questions, please do get in touch.